everyone, and welcome to the Secondary Spotlight. I'm Brianne Lynch, Head of Market Insight at EquityZen, and here today with a really interesting conversation on the key trends we've seen in the private markets over the first half of the year. I have Phil Haslett here, Chief Strategy Officer at EquityZen, joining me, and we'll unpack it all, what the trends mean and what it means as we head into the back half of the year. So thanks for joining me, Phil.
Happy to be here. A lot to talk about.
It's been an interesting year, to say the least. When we look at Q2, it's been a quarter of really volatility and then a lot of vigor. We started the quarter with that big shock post-Liberation Day tariffs, which really created this risk-off environment. We saw this VIX spike up to 52. We saw investor interest on our platform dip a sharp 38%. But that's really not the big story. The story is what's really happened after that. In that time, we've had this V-shaped recovery. In June, interest spiked over 56% on our platform to levels that we really haven't seen since March of 2023. So I'd love to get your take on that. What does this resilience really mean for the fundamental health of the market?
Yeah, well, it's been quite a wild ride, but what I think is super interesting is how we saw investors on our platform kind of adapt to like this new world, right? There was Liberation Day. There was a bit of a shock moment for a second, but it was quite short-lived. And I think it reminded me of the fact that investors still have a long-term belief and a long-term thesis in a lot of the private companies we see traded on the private markets, which is that there's a big bet on how AI is going to be kind of our generation's internet, basically, and it's going to have tailwinds for everyone. And then we also still have positive catalysts coming down the pike, more IPOs, eventually some rate cuts, positive regulatory environment, which I think we're going to touch on more. But it kind of just shows to me that instead of in previous eras where we might have been kind of stuck here for a little bit, we saw things evolve and kind of adapt quickly.
Absolutely. So you touched on a little bit what the exit market was like. We certainly have seen more exits happening despite some of that early hesitation we talked about. You had Klarna that paused their listing, but since then, the IPO window has seemed to open in some cases. Particularly in June, we saw listings from Caris Life Sciences, Chime, Omada. Circle was the standout then, only to be beat out by Figma in more recent days. So really showing that there is appetite for some of these IPOs. And we see the pipeline building a bit now with Klarna reportedly looking to go public this September. So based on all of this, would you say the IPO market is officially back, or what's your read on that?
Yeah, kind of say selectively back. The door is open, but not everybody can come in. Obviously seen some really big successes, as you mentioned, Circle, Figma. Before that, we had CoreWeave. What I think is really interesting is that we've also seen the companies that you listed that aren't your household names having successful IPO listings. I think that means that there are quite a few more companies that are now going to test the waters to go public, but you still have to have great kind of fundamental stories about your business, right? You've got to have pretty good scale at the top line, meaning hundreds of millions of dollars of revenue. No longer can you just be $100 million a year and go public. You've got to be able to show growth and profitability. And hopefully you are in a sector or a subsector that has some pretty positive tailwinds, right? And Circle's a great example of that. There has been a lot more, helping lift up kind of the crypto industry at large. And we kind of saw success there. And so cautious optimism, doors mostly open. It's still summer, right? So, things are typically a little slow, but pretty excited to see what comes next.
Me too. Sitting here on the sidelines, really anticipating. So it's an interesting contrast when you talk about the uptick we saw a bit in exits while IPO and exit values rose. We actually saw global exits hit a 3-year high in Q2. Overall venture activity, so private companies that are raising primary rounds of funding, actually saw a decline, in terms of proceeds raised, 20% from Q2 to Q1. So how do you kind of square this reality where you've had some healthy exits, but less funding versus Q1? What does that mean?
Well, I think one main part to highlight is that venture investing has gotten kind of lumpy when you look at it in the aggregate. And that's because some of these funding rounds are enormous, right? So what we had in Q1 was the close of an open round, right? Which was in the, I think $40 billion is what it was registered at. I don't think all of it closed, but that obviously moved the needle quite a bit and created a pretty high watermark for Q2. So I would suspect that we'll kind of get back up and running to things that like you saw in Q1 because of the capital needs for a lot of these privately held companies, particularly in generative AI. And I expect that to continue. And I expect the companies to be able to raise that money because of the fundamental belief that the addressable market, the revenue opportunity, the customer capture opportunity is so large and almost hard to define to the upside. And so I would expect things to kind of rebound and continue in Q3 and beyond.
Interesting. So, all right, we've talked about kind of the broader market, primary rounds. Let's zoom into the private secondary market where equities plays, the investment opportunities we're offering on our platform. We identified kind of four key trends as we look into the second half of the year. And one is that discounts have been shrinking and premiums are rising. So you'd say the past few years have been a true buyer's market. But in Q2, we saw the average discount that a company is trading at relative to that primary round go from 28% to 13%. And maybe even a bit more telling, the number of companies trading above their last primary founding round is now at 21%, and that's the highest we've seen in the past 2 years. So, Phil, is that window for discounts closing? What are the opportunities now, and what do these increases in valuation mean?
I certainly think discounts are going to tighten relative to the last round. If I recall, kind of in 22, 23, we probably saw the low point, which was probably maybe a 40 or 50% discount on average at EquityZen. I don't think we're going to ever get back to that number for quite a while. And I think it's a function of two things. One is that companies that raised a few years ago and were trading at a discount, the ones that have been able to right the ship and build their business back up and realize their value that they kind of commanded in 2021 have had that happen. And we're starting to see trades reflect that. There's another group of companies that raised back in 2021 that haven't been successful. But the reality is now that those companies have realized maybe exit far below what they were hoping for. And so there's not really going to be trades in those names at 50 and 60% discounts. They just won't trade anymore because they're either acquired or they're going to go to zero. And so you had some clearing out. The last part I'd say is that there's been a flight to quality, right? Which is some companies are going to win their sector or win their space. They are able to raise a lot of money and can be a little selective on who they raise money from. And so, in a way, kind of access is the new alpha. If your ability to get access to those companies at primary rounds or secondary tender offers or secondary trades is the way that I think we'll see investors kind of bet their chips, if you will. And that, as a result, will manifest itself in the discount kind of probably getting close to zero on the average and maybe even starting to trade at a premium, which is what we see when there's kind of overall macro opportunity within the private markets.
Access is the new alpha. I like that. Maybe one of our new taglines. Talking about, some of those macro factors that are impacting what industries are popular and what we're seeing in the market. One of the other big trends we've seen in the first half of the year was the return of the crypto craze. So after a period of relative quiet, crypto broke back into the top 10, one of the most popular industries now amongst our investors, making spot number 6 as of Q2. We know that Circle's IPO definitely created the sense of FOMO in the market, but there's also more to play. So can you talk about kind of some of the momentum behind crypto and what some of those macro factors are that are driving investor interest?
Yeah, absolutely. So crypto is certainly having its moment, though I'd admit it seems like crypto will have its moment every couple of years. This one feels a bit more tangible. Circle is a great example. The biggest part of Circle's business is a stable coin, right? USDC. And I think for a lot of people within kind of financial services, the stable coin is kind of the first real world application for blockchain that people can really wrap their head around, right? It makes money move faster. It's tied to the dollar. It's not about speculation. It's about actual transfer of an asset. So I think that's part one. Part two is that there's growing adoption for investments into crypto and blockchain companies in the form of publicly traded ETFs and mutual funds, and you've seen those scale up and grow. That's part two. Part three, I'd say, is that we've got bipartisan support for a lot of increased adoption for crypto and blockchain. And that regulatory tailwind can be incredibly powerful under new leadership in the SEC. And the last part that we're keeping an eye on is, a few years ago, there was really just one company that was parking their treasury cash in cryptocurrencies, and that was MicroStrategy. But we've seen the proliferation, if you will, digital asset treasuries. They call them DATs. I think it's a new acronym for me to get my head around. And we've seen a lot more companies start leveraging cryptocurrencies as a form of treasury, and that's going to be kind of a rising tide as well.
And that's a really interesting one to watch, just as it overlaps and blends with the broader fintech market. So, crypto and fintech aren't two separate markets at this point. They're really converging, and, something that's certainly going to be a trend that we watch going forward. Talking a little bit more about the trends that we've seen on, a backward-looking basis over this first half of the year. One of the things was emerging energy companies really, showing growth in terms of valuation across any other industry. Emerging energy companies traded at a premium to their last round of funding versus AI, crypto, or some of these other industries that are grabbing headlines. So, what's really to be made of this trend, and why do we see investors putting more value on some of these emerging energy companies?
Yeah, absolutely. I'd say it's two things. One is selling shovels to the gold rush, right? If you're going to have more and more AI models, you're going to need more and more power for data centers, et cetera, and compute. And that is funneling kind of an opportunity for an infrastructure play in the form of new energy. So it's less about ESG and it's more about we just really need more power to kind of run these large models. So that's probably the main driver. The second is I think there's a lot of eyes on protecting national interests, meaning our reliance on our own power sources, ideally away from dirtier forms of energy towards clean energy, is also driving that. So I think when you put those together, you've kind of got a perfect environment for companies that are having breakthrough technologies, probably because they're running it on new AI models to grow their business. And so we're seeing that kind of play out in Q2 and probably beyond.
Seems like a symbiotic trend you have between the two there.
Yeah.
So let's get into our final trend that we really saw in Q2 as we head into the back half of the year. We've seen a focus on the new kids on the block. Indications of interest on our platform, so what investors are telling us they're most interested in, is trending towards younger companies. We've seen growing interest in companies that are less than 5 years old, levels that we haven't really seen since 2018 in some of these AI, in some of these younger companies. And AI is certainly a part of it. A lot of these AI companies are younger inherently because the technology is younger. But as you think about investment opportunities in some of these younger, maybe less proven companies, how do you think about the risk reward, and what should investors be thinking about?
Yeah, well, there's always more risk for companies that are younger, and that's really a function of kind of execution, right? You have leadership teams that have only been doing it for 2 or 3 years versus, say, a decade. A lot of companies might still be finding product market fit, but fortune favors the bold. And I think we'll continue to see investors clamoring for companies that are younger, partially because these companies are able to grow so much faster. We kind of saw this for the first time maybe 7 or 8 years ago, really with the advent of kind of cloud computing, which meant that starting up a technology company became incredibly, probably 10 times or 100 times cheaper than it used to be. When you needed 100 engineers and servers, you only needed 10 engineers and no servers. That allowed companies to scale up faster. But what we're seeing now is an even faster rate of growth. Put simply, I think of this company called Lovable. I think they just raised money at about a $2 billion valuation. Lovable went from zero to $100 million in annual recurring revenue in 8 months. They had only raised $25 million and they only have 45 employees. And so on the one hand, you'd say, okay, yeah, people want to invest in companies that are only a few years old. Why is that? Well, the reality is if you look at how they're performing, they look like a SaaS business from a few years ago that would have taken a decade to get there. And so it stands to reason why investors really want to get into these companies. The last part I'd say is it's probably a bit of FOMO in a way, where OpenAI or Perplexity or Anthropic were companies that were, only $5 billion in valuation or $10 billion in valuation just 2 or 3 years ago. And now they've, skyrocketed to being worth, Anthropic's case, 170 billion, in OpenAI's case, 300 billion, now maybe 500 billion. And so it used to be that if you invested in a company at a $2 or $3 billion valuation, you thought maybe the upside was only 2 or 3x your money. But now if it can be 10x or 20x or 30x, it stands to reason why people are going to make those investments.
The FOMO is real. And the quest to find who the winners are. To recap some of the trends we talked about a resilient market. We've seen valuations tightening, a lot of momentum in crypto, energy, and just demand for these young AI companies. So as we look forward now to what the rest of the year will look like, wanted to ask a few questions, about what we've seen and what it means for the broader market. So, we talked about Figma a little bit earlier. What do you think this means in terms of market appetite for SaaS companies? Do you see it as a signal of broadening the window for those companies particularly, or, what does that mean?
Yeah, I would probably expand it outside of SaaS. I think the term SaaS is going to be a negative term real soon. But I think what it highlights for Figma and other companies was if you've got scale on the top line, right, in revenue, you've got great underlying gross margins, you have a product that people understand, and you're growing, you can be a successful company to go public. There aren't a ton of companies like that, to be very clear. I think Figma is not an N of one, but there's only a handful. And I think what it really is, it's kind of a reminder that if you're able to harness the power of AI for your business and can actually show real world, tangible application of it in the form of our product is better, we need fewer people, we have better margins, and our addressable market has gotten bigger, I think you have a really great chance to go public. On the other hand, legacy SaaS companies have got to be a little bit scared, right? The pitch, if you were a SaaS company before, was, businesses have a problem. We built a product that solves that problem. We spent years building it, and it's really good at what it does in this vertical. Well, when you have agents, right, AI agents, that can take a prompt from you and help you solve your problem, you may not need that very specific enterprise SaaS layer than you used to. So I think this is a wake-up call that traditional SaaS companies have to evolve their product to compete with what AI agents are going to be able to do for customers. That I think is the big wake-up call too.
Fascinating. Beyond IPOs, what are you seeing in terms of M&A? We've certainly seen some interesting stories in the AI market when it comes to Windsurf, Scale AI. How is this changing those dynamics in the market? And, what are you thinking about?
Yeah. There's really two kinds of deals happening within tech. One is a traditional kind of private equity buyout of legacy tech companies, right? Oh, we think we can make this company run more efficient, more lean. We can spruce it up a little bit and take it public in a few years. And that exists already. I'd say the new one is that we've basically got these acqui-hires masquerading as M&A activity, right? If you think of Windsurf in particular, if you think of Scale, it's really the hunt for a unique talent, individual talent, right? Which is the AI researcher or somebody with unique AI technical talent that are commanding 9-figure sums, right? Like athletes to go to these companies. And so I think that will continue. It'll probably reach an apex at some point. But right now, most of the M&A activity is really driven by a handful of people at those companies. And it stands as a big question of if that's going to continue until all that kind of talent has found its way into certain big companies, or a new crop of talent shows up and then no longer do you have to pay $125 million for a researcher to go to Meta.
So, we're talking about M&A. Regulation sometimes plays a role in how M&A happens, but regulation plays a role in a lot of other, narratives and potential outcomes when it comes to some of these private market investments. So what are some of the regulatory changes or themes that are on the horizon that you're tracking that could impact this market?
Yeah, I'd say two of them are about access. Right now, for the most part, to invest in the private markets, you need to be an accredited investor. The rules around that have pretty much been static for the last 30 or 40 years. And we're seeing that potentially what will come through regulation is that more and more people will be considered accredited investors. That would broaden access and opportunity. The other theme we're seeing is that we may have new regulation around 401ks being able to invest in alternative assets. That's $12 trillion sitting in 401ks that might go towards alts. To give you a comparison, investment retirement accounts, IRAs, are 17 trillion. And so that is a big pocket of opportunity, but also risk to consider. And the last part I'd say is that there are a lot of eyes on the idea of tokenizing public and private equities, which also comes with risk. But the general theme for these, and we'll see how it all plays out, is in my opinion, kind of the decentralization of financial markets, right? In the form of more advents on crypto, more access for people, more usage of retirement accounts. With great power comes great responsibility. I think this will lead to great opportunities for people to make investments, but I also think that it's a little scary sometimes when we get a bit more greenfield on how people can make investments. So we're keeping a really, really close eye on EquityZen on how these things are going to pan out.
I think those trends are really going to shape the market. And I have a follow-up question with you that kind of ties around this democratization trend we're seeing, based on these regulatory themes that you talked about, and almost feeds back into the Figma IPO story. That was an IPO that was priced, and then when the general retail market was able to access it, that stock ran up. And yes, it's come down, but a big piece of that is that the traditional roadshow did not account for the retail demand for the company. And it's something that we've seen at Equities where we have a better pulse on the individual investor and what demand is like for some of these companies than, the big institutions running these primary funding rounds. Think about these regulatory themes. There seems to be something about the individual investor, having more power. And how do you think that plays out?
I think we see it first in public markets, right? What we saw with Figma, what we've seen in a run up on crypto valuations. How it translates into the private markets is that we'll see a continued enthusiasm and desire from our clients at EquityZen to invest in the next generation of great technology companies. And I don't think that's going away. And I think that will continue as we get kind of breakneck speed releases on new technology, right? And things are by no means stagnant on what's going on within tech. And so it'll be exciting times. As with any cycle, there will be winners and losers. But I kind of go back to the example that this seems like since really the rollout and release of the internet, there hasn't been a fundamental technology theme that can lift like the entire GDP of an economy. And we're kind of seeing that play out on company by company levels. And so it's really exciting.
Absolutely an exciting time to be in the general markets, certainly in the private markets. And it's just fun being here at EquityZen and having a front row seat to all of that. So, Phil, thank you for, taking the time and chatting more with us about some of these themes. We'll have to come back in a few months and see how this is all coming to fruition. But as always, thanks for a great chat on the market.
Thanks for having me.